Welcome to the deep dive. Today, we're taking a deep breath and plunging into the latest Trading Post report. And it gives us this incredibly focused and, frankly, pretty sobering analysis of the structural headwinds facing European markets right now.
It's a fascinating document. It really is. It sets up this core paradox. So our mission today is to extract those key insights. How can a region that's facing these, severe, maybe even existential long-term problems still maintain a surprisingly solid business cycle in the short term?
And how does that crushing new US-EU trade agreement shake up Europe's entire cost competitiveness? I think we should start with the conclusion because that's probably the most surprising part of the whole analysis.
Let's do it. Usually when you talk about systemic structural headwinds like these, the investment conclusion is caution or, maybe even an underweight rating.
Right. Stay away.
But this report takes a much more calculated risk. It actually maintains an overall overweight stance on European equities.
Okay, but that headline has to come with a very heavy caveat.
It does. A very heavy one. The overweight position is overwhelmingly biased toward defense stocks.
And that bias tells you everything, doesn't it? It tells you where the guaranteed capital flows are going. It suggests that even if the rest of the continental economy really struggles, there was one sector that's completely insulated by political commitment.
Precisely. And that tension, the short-term resilience versus that long-term decay, that's what we need to unpack.
Okay, so let's unpack it. Let's start with part one. That surprising short-term resilience. The data shows the European business cycle expansion. The profit cycle that started way back in 2021 it's still intact. How?
Well, it's possible because corporate health is fundamentally strong. People often focus on the headline GDP numbers, which can be weak. But if you look underneath at the actual corporate landscape, the balance sheets are just robust.
So give us the hard numbers. What is it that makes European companies so financially secure right now that they can fund future expansion?
It really all comes down to their cash position. The report shows three critical metrics. You've got EBITDA, free cash flow, and retained earnings. All of them are sitting comfortably above their pre-pandemic 7-year averages.
So they have the cash on hand.
Exactly. They are not cash-strapped. And that means they can fund expansion plans, they can fund payrolls without a lot of strain.
And that strong footing brings us to the cost of capital. I mean, if balance sheets are strong, they're not totally dependent on cheap debt. But the ECB has been cutting rates this year, which must be offering some relief.
It is a lot of relief. The ECB has delivered 100 basis points of rate cuts this year, and there's an expectation of maybe another 25 basis points before the year is over.
And that easing has moved a key indicator back into safe territory.
It has, specifically the 2-year real lending rate.
Okay, for listeners who don't track the ECB daily, what does that mean?
So the real lending rate is what really matters because it accounts for inflation. It's the true cost of borrowing. Historically, if that real rate is outside a plus or minus 2% threshold, it basically acts as a binding constraint on growth.
So too high, companies stop investing. Too low, you get reckless borrowing. Where is it now?
It's now back within that normal range. The implication there is huge. Borrowing costs are just not a material obstacle for European companies or households right now.
And that creates a nice cushion.
A huge cushion.
Yeah.
And it gives the ECB more flexibility, especially since inflation in the euro area is pretty well anchored at a benign 2.1% year over year.
And the labor market, that's another key point of difference with the U.S., isn't it?
Absolutely. The employment picture there just continues to improve. Unlike in the U.S., where we're seeing joblessness start to creep up, the euro area is still seeing it decline. Strong hiring in services is more than making up for losses in manufacturing.
And what about wages?
Real wage growth, so the growth that actually hits consumers' pockets, that rose 1.9% year over year in the first half of 2025. And that supports domestic demand. It keeps that internal engine turning over.
So a strong internal engine, supportive monetary policy, but that engine is now being hooked up to a massive, expensive anchor. Which brings us to part two, the structural icebergs. And we have to start with a trade agreement that officially ended the US-EU trade war. The report calls it a poor bargain. That feels like an understatement.
A massive understatement. It is a stunning reversal of competitive positions. The agreement was reached in Scotland back on July 27th, and when you actually break down the terms, the strategic and financial victory for the U.S. is just overwhelming.
Okay, so let's break it down. What did America get?
The U.S. basically secured a blank check for its industrial exporters.
Hmm.
The EU agreed to eliminate all tariffs on American industrial goods coming into the bloc. And on top of that, Europe pledged to massively reduce non-tariff barriers. So we're talking streamlined regulations, simplified certificates, less red tape.
Zero tariffs and zero friction for U.S. goods.
Exactly.
Now, the EU waves American industrial products right in. What?
What?
Accepting a severe hit to its own flagship sectors. What was the cost for Europe?
Europe paid with its export competitiveness, right across its most valuable high-tech sectors. EU exports to the U.S., so think autos, pharmaceuticals, semiconductors, they now face a punitive 15% import tariff.
15%. I mean, it's lower than the threatened 30%, but that's still a shocking number.
It's a shocking imposition, and critically, the existing high duties on things like steel and aluminum, they remain completely unchanged.
A 15% tariff on semiconductors and cars. Given Europe's productivity struggles already, how is this not a near-death blow to their global competitiveness?
It just radically transforms their cost structure overnight. The numbers that quantify this should terrify every European exporter listening to this. The EU's average trade-weighted tariff rate. It's skyrocketed from just 1.36% at the start of the year to a massive 16%.
16%.
That number alone signals a profound structural vulnerability.
And just so we understand the scope, this isn't just targeting specialty goods. This new rate applies to almost everything, right?
That's right. According to the September data, the higher tariffs apply to 95.8% of all EU exports heading across the Atlantic. This just fundamentally changes the economics of selling European goods into their single largest market.
And then to compound this trade shock, you have the double whammy, as the report calls it, of the euro's appreciation.
Yes. The structural trade pain is layered right on top of currency strength. The euro is up a hefty 17% against the US dollar since January. Now, in economics, exchange rates, they impact trade and export pricing with a lag. Usually it's about 18 to 24 months.
So we haven't even felt the full competitive hit yet.
Not even close. The combination of a strong euro and high tariffs means European exporters will be at a significant disadvantage for many quarters to come. This isn't a quick fix. It's a permanent structural shift.
Okay, so if the trade deal wasn't bad enough, let's move to part 3. The deeper structural issues beyond tariffs. Let's start with the technology lag. Europe is demonstrably losing the race for innovation, especially in AI.
The report is very clear on this. Europe is falling further and further behind the US and China in the advanced technologies that are going to determine future productivity. I mean, only 4 of the world's top 50 tech companies are European.
Just 4.
And the EU's global share of tech revenues has shrunk dramatically. It's fallen from 22% a decade ago to just 18% in 2023, while the US share rose significantly.
That is a huge strategic vulnerability. And when you talk about high-tech industries like AI, like data centers, the infrastructure costs have to play a role in that lag.
A massive role. And this links directly back to cost competitiveness and the energy crisis. European energy and electricity prices are still running 2 to 3 times higher than they are in the US.
2 to 3 times.
Think about the energy needed for data centers, for AI processing. The cost of operating these high-energy industries in Europe is a major, major hurdle.
Okay, now let's connect that deep technological and cost struggle back to the geopolitical picture. The fiscal commitments Europe made to the U.S., particularly with this trade deal, they feel almost contradictory. They're spending huge amounts of money abroad while they're struggling to modernize at home.
It creates immense fiscal pain, real strain on national budgets. Europe pledged to invest a staggering $600 billion in the U.S. during the previous U.S. administration's term. And that's focused on U.S. energy, U.S. defense, U.S. infrastructure.
600 billion euros. That's 3.3% of the EU's entire GDP. And that's happening while they are struggling to meet their own 2% NATO defense commitments at home.
Right. And that's not the only financial drain. Europe also pledged to buy at least $750 billion worth of U.S. energy through 2028. This diversion of capital, both public and private, away from European producers just completely undermines their own industrial base.
And this overwhelming realization that the U.S. is shifting from a reliable ally to, well, a transactional partner imposing these harsh terms, that must be what triggered this huge investment pivot.
It is the defining geopolitical shift. It underpins the entire investment bias in the report. This is the moment the fiscal priority fundamentally shifted away from things like the green transition and social spending and toward defense self-sufficiency.
Which brings us full circle, back to the investment conclusion, that overweight on defense stocks, the commitment made at the Hague summit, That explains why this sector is bulletproof.
It provides the guaranteed revenue stream that no other sector in Europe enjoys right now. At that 2025 Hague summit, NATO members collectively pledged to raise total defense-related spending to 5% of GDP by 2035.
5% of GDP. That is a gigantic, decade-long fiscal priority.
It is, and that figure is split into 3.5% for core military spending and another 1.5% for adjacent investments like cybersecurity and logistics. So even as fiscal strains get worse, even as trade weakens, this 5% commitment is politically and fiscally guaranteed. It's insulated from the budget pressures that will hit everything else.
And that, ultimately, is why the report maintains its overall overweight stance, despite all the structural doom and gloom you've detailed. The guaranteed revenue flowing into defense basically compensates for the weakness elsewhere.
It's a classic flight to guaranteed demand. The defense sector just offers safety in a structurally challenging environment.
So what does this all mean for you, the listener, right now? We started with the tension, and we're ending with it. Europe is, for now, stable, strong corporate balance sheets, benign borrowing costs. But it's facing this historic, three-pronged structural challenge. A punishing 16% tariff on exports, a massive technology lag driven by high energy costs, and the soaring defense commitments that are diverting huge chunks of capital.
That's the summary. These structural issues, they just fundamentally underscore the need for urgent, comprehensive reform. Without a serious effort to regain cost and export competitiveness, the short-term stability we're seeing today could erode very, very quickly.
A truly insightful, if, well, deeply thought-provoking deep dive into the vulnerabilities exposed by these shifts.
Indeed.
If you like what you hear and want to know more about the in-depth report for which this information was sourced, please email sharmila.whelan@wethborn-research.com. Thank you for joining us for this deep dive. See you next week.